Hello, everyone. Welcome to the weekly roundup. Today we will cover inflation, some economic data, and earnings releases. Hello, Ben.
Hey, Eva.
How's it going downtown?
Few technical difficulties with the computer and such, but otherwise cold and rainy. We had a fire drill this morning, so that was
Oh,
exciting.
not fun. Well, we see you, we hear you, so I think we're good to go.
Excellent.
Okay. I'm gonna start off with inflation numbers coming in slightly higher. Could this impact market expectations for the size of next week's potential rate cut?
Yeah, so it's a good question. I mean, I think that this because I think we've been so wrapped up in inflation for so many years now. There's a lot of focus on those little moves every month, a little bit different here or there. But I think that since at least since Trump got in and tariffs and how the Canada-US relations have been, the focus for the central bank at least has been around what's going on with the economy and what's going on with the employment numbers. And so it looks like employment numbers have risen in Canada, as you know, and the economy is slowing and likely to continue to slow. And so I think that will, at least that's what we think. Our economics team thinks that they continue to move forward on a cut next week. And going into the CPI number, we were something like 75% likelihood of a cut. It did change a little bit on the data, but we're still leaning towards two cuts this year. So that would be one next week, and then one more before the end of the year. So yeah, it's not as aggressively priced as it is in the US, but still leaning towards a cut next week.
Okay. Um, US debt is now around 120% of GDP, and interest expense is rising. What does this signal for the US economy?
Hmm. That they need to get rates down, I think, somehow, magically. I mean, I think that they have just like every place in the world that had the world reserve currency at some point, you get a lot of advantage to being that currency, and still something north of 80% is of the daily transactions in the world are done in US dollars. So as a result of that, they got a lot of room to push the boundaries and raise debt and do a lot of things that they're doing now. So um, Japan has taught us that it doesn't matter how bad it is, that ratio. If you bring rates down to zero, then you don't accumulate any interest payments, and you can roll that out for perpetuity. So, I think for the U.S. debt, I do think they want it to come down, and I've said this a few times, and I don't know when this will happen. Likely with the next Fed chair, is you see some kind of like like when Bernanke was in, he called it Operation Twist, which was he would sell short dated and buy long dated to flatten out the curve and bring their costs down. So I think at some point that'll be implemented. It's not tomorrow, but potentially sometime later next year, depending on how things play out. And so I think, yeah, rates are too high for the U.S. government's liking, but right now, at least market forces are controlling it. At some point, I think there'll be intervention.
Okay. So the US regional banks came under pressure this week due to a rise in non-performing loans. Now, why is this trend important for investors, and what could it signal about the health of the broader financial system?
Yeah. So one thing that I think that we learned through the great financial crisis is that the financial system is interconnected.
Yeah.
The one issue with the U.S., or we'll say maybe they see it as an advantage, is there's thousands of banks out there, and so when you reference regional banks, so there's less contagion risk in the regional banks than there is in the big banks, but in a lot of cases, the regional banks also lend to the same companies that the big banks do. So there was this tricolor, which were subprime auto loans that they filed bankruptcy. As I read through it, there's this concern about loans upon loans. and that sounds a bit like subprime, where you had tranches lent out, nobody knew what was in them, the quality of them got worse and worse and worse. So the immediate reaction last week was negative, regionals down. This week, people seem to be brushing it under the rug right now, but it is showing some cracks in the system. Because that's subprime auto loans, you're also seeing delinquency rates on autos creep up right quite quickly in the U.S. And so it could be systemic that we need to watch and pay attention to. But the loans upon loans is something that makes me stand up and pay attention. I don't think it's immediate risk, but it's one to watch and track.
Okay. So gold and silver. Sharp declines this week. Is this a short-term correction? Could this signal a long-term shift in that market?
Yeah, so I think it's a great point. I mean, we've been talking and tracking gold and silver now for a few years. I've been, really started to get interested in following it around 2010, 2011. So, that was the last peak. And then went into a bear market for 5, 6, 7, 8 years, something like that. And the attention's come back towards gold with the concern about potentially the US dollar, to your point around US debt levels. So you've seen a lot of central banks around the world buying gold. There's limited supply in physical, which people seem to jump up and down about being an amazing thing as why you should own it. And maybe that's the case, I don't know. Um, Coming up into last week, we saw a huge run up, and I think this would have been the third week in a row where I said, gold's overbought. At some point, there's going to be something that causes it to tip over. I don't know if we referenced it on the call. I don't think we did last week because I made the trades into the close on Thursday, but did reduce exposure to gold and silver miners going into the end of the day Thursday. And felt happy about it Friday, sad about it Monday, and then happy about it Tuesday when it went down significantly.
What a
So,
roller coaster.
so it is a volatile asset. I think to answer your question though, what does it mean? I think it means that there it was an overbought asset class that corrected. The fundamental reasons so in gold haven't changed at all. We still see massive risk in the world, geopolitical risk. We see central banks continuing to buy it. And so fundamentally, I don't think anything's changed. It's just the technical nature of it now that'll be important to watch because there's all these technicians are, in a panic mode when something moves like it did on Tuesday. It was, for all these people that want to fall like standard deviations and sigma events and things like this. Like it was a 4.5 sigma to the downside, which is something that happens one in every 400,000 sessions or something along those lines. So it was a material move, but since then, gold settled down, volumes have settled down, the miners have seemed generally settled down as well. So I think the next, few trading sessions will be important to say, now do things settle down, relative strengths moderate, and so I would be leaning towards, I still think there's more upside, but it was a huge amount of increase in the past 6, 9 months where we went up 100+%, and it was just a matter of time before we saw a correction.
Okay. So my last question, earnings season rolled in. Are there any standout results or trends worth noting?
I'd say there hasn't been anything super material except for today. Volvo came out with some earnings and the stock was up 40%, which is crazy for a car company. So that was a real surprise. Haven't dug in too much into the numbers as to what the justification for the jump was, but certainly that was a surprise to the upside. I mean, Tesla reported this week as well. Market didn't really like it, but not material. It was down a couple percent on their earnings numbers. Banks have come out with their started their earnings in the U.S. Trading was up, which makes sense, but nothing huge on that side. I think from a area that I've been following tracking would be private equity. And so Blackstone came out this week and said they have a biggest IPO pipeline that they've ever had in their history. We'll see that. That's interesting. Maybe they're trying to start to bring some of these companies to market. They're feeling like there's enough liquidity in the market now, higher prices. But that would be Blackstone, KKR, Carlyle. It'll be worth watching and paying attention to see what that looks like. But yeah, Volvo was probably the biggest surprise.
Okay. So we're gonna go into the charts. I'm gonna bring it up and let me know if you can see it okay.
Okay.
Okay. You good?
All right. Yeah,
Okay.
perfect. Yes. So got a new look this week on the charts of the week. So we are recording this on Thursday, August, I wish, October 23rd, around 1 o'clock. So anything that happens after this, we'll certainly comment on next week. Just flip to the next. There we go. Okay, perfect. So this I think is probably important and relevant. And as I look through what's going on this week, and Carney spoke last night, and he's been out quite often, just talking about what's going on. The budget's coming up in 2 weeks, I guess, November 2nd, I believe. And so there's a lot going on, but this is a great chart that just shows you how much we are dependent on the U.S. market now. And so where you'd see Trump talking about putting pressure on Canada. I obviously he feels he has lots of leverage because of our dependency there. And so one of the things that I think Carney's been doing, or at least going around talking about, how they're trying to change and diversify the economy that gives us the ability to be more dynamic and more flexible. So I thought this was a great visual for why it's so important, the relationship that Canada and the US has right now. And what we do from here, I think, plays a major part for how the economy does for the next 5-10 years. Um, this is also kind of hammers home that point a little bit more, because I think there's generally an overarching feeling around the fact that the tariffs haven't played a part in what's happening in Canada. So this is Canada. No sector's been spared from tariffs, and it's really true. Yes, there are some that are hurt more than others, but the whole of the Canadian economy has been negatively impacted from the tariffs. And to your point that you asked off the top, is the central bank going to be more concerned about inflation, or are they going to be more concerned about unemployment? And I still think they're leaning towards the unemployment and economy perspective at this point. And so this was a great visual just to see that every sector has been negatively impacted from the tariffs that have put in place. So I thought we'd put up a chart, and I don't often talk about asset allocation, markets, performance, etc. I thought this was a reasonable visual just to think about the kind of the expected returns, because we've had a good year this year, good couple of years actually since 2022, and so there's I think an expectation that returns should be 15-20% on a continual basis with no downside. This shows a pretty good divergence between what a 1 year looks like historically, what a 2 year, 5 year, 10 year looks like. And this is a max growth portfolio. So this would be, we'll say all equity, maybe a sliver, 5-10% fixed income or cash. But so this would be a highly aggressive equity portfolio. And if you look at it on the right-hand side of this chart, you're going to see that on an ongoing basis, that rate of return profile is much lower than the 15-20% that we've seen this year. And just rationale around thinking around, we've had a good year, a good couple of years, taking some off the table. Future expected returns are a lot of the conversations I'm having right now is, do we expect this to continue? Do we expect this to continue for the next 6, 9, 12 months? And what's the expected path forward? And I think it's just a reasonable thought rationalization to think about, returns that are 15, 20% aren't the norm on a long-term basis. And I think it's important just to think about what that means from a risk profile. And that's what we do when we're managing risk and asset allocation at this point. And as always, our opinions don't necessarily reflect those of National Bank Financial. You should always consult either myself or your financial advisor if you have any questions. Everyone's risk tolerances is slightly different, and that's it.
Great. Thanks, Ben. We did it.
We did it. Made it.
So what's on the agenda for next week?
So rate cuts next week. So Wednesday of next week, we will see what Canada and the US does. So that'll be important to watch. The gold and silver market, which we talked about, and the miners market will be important to see how that recovers, what transpires next. And earnings will continue to be the story of the day to pay attention to. So I'll be looking at paying attention to those. There's a couple other things I just wanted to comment on. Yeah, we see Trump continuing to pardon a lot of people. So he pardoned the guy that started Binance, so big crypto company from China. And so we're continuing to see those pardons come through. You know, that is, I think, continues to be a geopolitical risk to pay attention to. But the main event will be Wednesday next week. Obviously, rate cuts in Canada and the US, and watch the minutes and watch the presser from Chair Powell on Wednesday afternoon. That'll be important for us to watch.
Yeah. Thank you. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video, as well as in your inbox if you're subscribed. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you for listening and have a great weekend after Friday. Bye.
Exactly. Thanks. Take care.